The Federal Reserve's recent decision to cut the federal funds rate by 0.25 percentage point, bringing it down to a range between 4% and 4.25% as of September 17, 2025, marks a pivotal moment for both the markets and the broader economy. After a prolonged period of rate increases, where the Fed raised rates from near zero in early 2022 all the way to 5.5% by mid-2023, this change signals a significant shift in monetary policy. What does this mean for you, your investments, and your financial well-being? Let's break down the mechanics, the immediate effects, and the strategic moves you can make to position yourself for the future. To start, it's essential to understand the role the Federal Reserve plays in shaping the economic landscape. The Fed isn't just another government agency, it's the central bank of the United States, responsible for balancing two critical mandates: keeping prices stable and promoting maximum employment. Its primary lever for these goals is the federal funds rate, which determines the cost for banks to borrow from each other overnight. When the Fed raises rates, it's essentially making borrowing more expensive, which tends to slow down economic activity and tame inflation. When it lowers rates, as it has just done, it's encouraging spending and investment by making money cheaper to borrow. This latest rate cut isn't happening in a vacuum. Over the past year, the economic environment has shifted. Inflation, which soared to multi-decade highs in 2022, has moderated but remains stubbornly above the Fed's ideal target. Meanwhile, the labor market, once red hot, has shown signs of cooling. Job creation has slowed, and unemployment has ticked up ever so slightly. These indicators prompted the Fed to pivot, opting for a rate cut in hopes of reigniting economic momentum and sustaining growth. But how does a Fed rate cut ripple across the various sectors of the financial markets? Let's look at the most immediate impacts. First, the stock market tends to react positively to lower rates, at least in the short run. Lower borrowing costs mean businesses can invest more aggressively in growth, innovation, and expansion. For technology companies, which often rely on financing to fund rapid development, this is a welcome development. That's why, following the Fed's announcement, tech stocks led the charge. Modest but noticeable gains were seen in sector ETFs, reflecting investor optimism. Real estate stocks also benefited. Lower mortgage rates make home buying more affordable, and demand for property, and by extension, for real estate investment trusts, generally rises. For instance, the iShares U.S. Real Estate ETF, IBR, saw its value climb to $97.04, signaling renewed interest in property-related investments. On the flip side, the bond market isn't quite as enthusiastic. When rates fall, the yields on new bonds drop, making them less attractive to income-seeking investors. Existing bonds with higher coupons become more valuable, but new bond purchases offer diminished returns. This dynamic played out immediately. The iShares Core U.S. Aggregate Bond ETF, AGG, and the Vanguard Total Bond Market ETF, BND, both saw slight declines, trading at $100.18 and $74.31, respectively. Savers, too, face headwinds. Interest rates on savings accounts and certificates of deposit invariably drop, making it harder to earn meaningful returns on cash holdings. For borrowers, however, the environment has improved. Those with variable rate loans, think adjustable rate mortgages, home equity lines of credit, or personal loans, stand to see lower monthly payments. Even fixed-rate loans become more attractive as refinancing opportunities emerge, potentially freeing up more disposable income for households. Zooming out, what does this rate cut mean for the trajectory of the markets and the economy, both in the short term and the longer haul? In the near future, optimism tends to dominate. Investors interpret lower rates as a sign that the Fed is ready to support growth, and money shifts from safe havens into riskier assets like stocks. The S&P 500, for example, has seen cautious but steady gains, trading around 669.21, a reflection of both new hope and lingering uncertainty. Yet, volatility remains a constant companion. While the rate cut may buoy markets initially, other economic indicators, like employment reports, GDP growth, and inflation metrics, will continue to sway investor sentiment. If inflation reignites, or if the labor market deteriorates further, the Fed may be forced to reverse course, hiking rates once again and sending shockwaves through the market. Over the longer term, the impact of this rate cut will depend on how the economy responds. If businesses ramp up hiring and investment, and if consumers spend more confidently, we could see a period of sustained growth. Unemployment might decline, GDP could accelerate, and corporate profits could rise. The Fed itself has signaled that more rate cuts may be on the horizon, with projections pointing to a policy rate near 2.9% by the end of 2026. This suggests a gradual easing cycle designed to balance growth with inflation control. However, there are risks. If the Fed cuts too aggressively, it could overstimulate demand, reigniting inflation and undermining price stability. This delicate balancing act means that investors and savers must remain vigilant, adapting strategies as new data emerges. So, how should individual investors respond to this changing environment? The first step is to reassess your portfolio in light of the new interest rate landscape. Cash holdings, while safe, are likely to lose purchasing power as savings rates decline. Consider reallocating some of your cash into assets that can benefit from lower rates. Stocks, particularly those in technology, real estate, and financial services, may offer attractive growth potential. Companies with solid balance sheets and strong earnings prospects tend to fare well when borrowing costs are low. Be cautious with bonds, especially those with low yields. While they offer stability, their returns may lag behind other asset classes in a falling rate environment. If you value income and safety, focus on high-quality bonds that were issued at higher rates, or explore alternative income-generating investments. Don't overlook the value of investing in yourself. In times of economic transition, enhancing your skill set or deepening your financial literacy can pay dividends. Take time to learn about new investment vehicles, emerging trends, or strategies for risk management. Being proactive and informed will help you navigate uncertainty with confidence. Additionally, keep a close eye on upcoming economic reports and Fed meetings. The path of rates isn't set in stone. Future decisions will hinge on the evolution of inflation, employment, and overall economic health. By staying informed, you'll be able to anticipate changes and adjust your strategy accordingly. As we reflect on this turning point, remember that the financial markets are dynamic and ever-changing. A Fed rate cut is both an opportunity and a challenge. It opens the door to growth, but requires vigilance and adaptability. There's no universal playbook for success. Each investor's situation is unique, shaped by individual goals, risk tolerance, and time horizon. By understanding the mechanics of monetary policy, watching the market's reaction, and making thoughtful adjustments to your portfolio, you can turn this moment to your advantage. Whether you're a seasoned investor or just starting out, the key is to remain calm, informed, and proactive. Change is inevitable in the world of finance, but with careful planning and a willingness to learn, you can thrive in any environment. Stay engaged, continue to educate yourself, and embrace the opportunities that arise from shifts in policy and market dynamics. Thank you for tuning in to this breakdown of the Federal Reserve's interest rate cut and its far-reaching implications. Keep following the latest developments, stay curious, and remember, the most successful investors are those who adapt, learn, and act with confidence.